What are the markets telling us with all of this that's happened? And I think what they seem to be telling us is that things are not as bad as we'd feared they might be. I don't think that's a hard argument to make. When you looked at long faces in March and amazing declines in markets, the fear was evident everywhere. At this point, I think we actually do have some sense that it's not going to be the end of the world, as I mentioned earlier, and that as a consequence, you've got a little bit of loosening up of people's willingness to invest in the markets. You see a little bit of money dribbling back into mutual funds. Charles Schwab has indicated that they're looking at a pickup in trading activity. Housing seems to have finally bottomed. I think that depends on the geography you're talking about more so than not. Eastern Washington never really had a big boom. Texas is pretty stable because they never really had a bubble. On the other hand, this area, parts of the West Coast, especially the southern part, are really challenged. And quite honestly, while they had avoided it for a large portion of the time, the Pacific Northwest I-5 corridor, which is Portland to Seattle, heavily technology-driven, was late to the slowdown in appreciation, and they're definitely still going down. So there are parts of the country that are still challenged. My own personal opinion is when you look at the long-term appreciation in housing, we're not going to see housing or real estate come back for decades. Most people don't realize that if you go back and look 60 or 70 years, the average annual appreciation, except for the period from the mid-90s to the mid-2005, 2006 era, was 1.5% a year. I think it's important to understand that homes were never really investments. They are the largest consumption item we ever buy. If they happen to appreciate in value, that was marvelous. Some old collector cars do also, but as a practical matter, they never were an investment that produces anything. We forgot that as interest rates came down over the 80s, the 90s, to the point where people could simply refinance. Americans, the average American doesn't live on what they pay for something. It depends on how much per month they can afford to spend. As interest rates came down, mortgage rates came down. As mortgage rates came down, the ability to buy the same amount of house for the same monthly payment simply allowed you to keep buying a bigger and bigger house. We carried that to a point of manic foolishness, and now we're paying the price, unfortunately. I think the question about how credible the expectations are of stabilization and recovery depend really on some important issues that we have to face. As I say here, the devil's really in the details because we have some massive economic challenges in this economy today because of the amazing amount of debt we've accumulated. So I'd be really careful about making any broad generalizations, except for the ones I'm making today myself, because it's otherwise probably imprudent. Quick look at what's happened in terms of the markets, just to give you a visual sense. This is a graph with a whole bunch of different yields on it. I think what's important to understand, and you can dig into it in details, and I'll be happy to talk to anybody afterwards, but what you'll find is this is the basic range of interest rates for a number of different grades of investments, both taxable and tax-free, running from the beginning of 2007 through last week. And what stands out, obviously, is that remarkable spike that occurred starting in the fall of 2008, going straight up. Those two top yields there, curves, are actually high yield or low grade bonds, junk bond curves. The light blue and brown are investment grade. Most of the others are treasuries. So what we've seen is a period where everything had gotten squeezed down very tight, where people were not really being paid sufficiently to take risk back in 2007. They were scrambling to get all the yield they possibly could, not mindful of the risk that was in the system. As we started seeing things come apart, that first spike in that sort of off-green graph that's at the top is the Bear Stearns problems in the spring of 2008. You got some recovery, and then we saw the meltdown in the fall. What happened here basically is when the capital markets, when everybody started to panic, the capital markets simply shut down. There was no one prepared to put out bids to buy what was out there. You had people, whether they needed to sell for routine reasons or because they were panicky, trying to liquidate into the nightmare that was October after Lehman's collapse. You had this amazing spike to the point where actually those high-yield bond indices got up into the 20% range in in early winter, late fall, I guess. And we've been recovering ever since. The pattern I think that's significant is we're back to a point with virtually all of these curves now where in a lot of cases we're not being paid any better for risk than we were back in 2007. And yet I think there's a lot more risk in the economy, especially in the corporate market, than we're currently allowing for, because it's really not clear that the economy can grow without the government doing the spending. If you adjust for approximating the amount of stimulus the federal government is putting into the system right now, the economy is not recovering on its own. It's recovering because we're buying our way into this with additional methadone injections or whatever it is for the addiction, trying to get things to continue forward. The simple reality is, standalone, it's not turning yet. And as a consequence, I'd be very careful about low-grade investments in this environment, because you're simply not paid to take the risk for the bankruptcies that are likely to take place. Next page, we just got a quick look at the S&P 500. Again, give people a sense of where we've come from. It's nice to look at that 50% move off from an unbelievably low bottom point in the spring. But to put it in proper perspective, at 1,050 in round numbers today, we are an awfully long way from the 1,500 number that we saw in the S&P 500. So the recovery in this period has only been about a third of what the sell-off has been. There's a lot of damage still out there in the system. And I think one of the other speakers will point out there's been a tremendous amount of economic damage to consumers, something on the order of about $15 trillion that was wiped out so far between loss of household real estate values and their investments in 401k plans and equities in the personal sense. When you look at where we stand today in terms of the details, I think what's really interesting is this is the first recession that I've ever seen, and I started in the early 70s, where we've actually seen the recession with extraordinarily low rates. Most of us that have gone through any number of recessions over the last 30, 40 years, every recession tended to be caused by rising rates, restriction on the availability of credit, generally because the Fed was trying to slow down an overheated economy. Keep in mind, this was a world economy at this time where there was really only one engine routinely. It was the U.S. engine, so when it got going too fast, they slowed it down. When it slowed down, they tried to get it going. In this recession, as compared to all the others, we are actually looking at the lowest interest rates that we've seen in the last 50 years. It's impossible to look at the low rates today that are out there as compared to all of those prior recessions where once the economy started to slow and the Fed eased up on their tightening, you saw the economy start to reaccelerate again as rates came down. We don't have that luxury in this recession. Rates are already lower than they've, quote, ever been, using the term loosely. As a consequence, cutting rates is not a material solution. And the irony is there's no capital out there to borrow anyway because the banks aren't going to lend it to you. So this is a fundamentally, dramatically different environment than anything we've seen in any other cycle. And to have some of the talking heads on CNBC come out and say, well, this is, when you look at the last 4 recessions, this is what happened, and that's why this is what's going to happen this time. I apologize, but I simply don't buy the argument that the past recessions are analogous as a means of proving the nature of this recovery or the recovery in the markets.